Hello, ladies and gentlemen. This is Jesse Colombo, and I'm excited to do this webinar today. It's one of the first webinars I'm doing with Cyber Trading University, and this time I have many of my social media followers who have known me for many years, who have registered, and they're in the audience, so I'm excited to be among friends and to have this new medium where I can communicate with my voice instead of just on Twitter or Facebook or other written forms. So this is definitely an answer to my prayers because I've been looking for a way to speak naturally instead of always be confined to just text, even though I love to write. So definitely going to be doing more of these webinars and develop all sorts of new content and pretty much take it from there. So if you can type into the chat bar, tell me if any of you follow me on Twitter or know me from Facebook or other forms of social media. I'd love to see that. You can just type right into the chat box. So today's webinar is called How to Forecast Forex Trends Using Futures. And anyone who follows me knows that this is a topic that I discuss fairly frequently, and I write about it, and I find that it integrates well with the topic of bubbles and economic crises, goes hand in hand with this topic that I discuss very frequently and study and try to warn about. And for me, they're not mutually exclusive. For me, I'm watching Forex and I'm watching futures and I'm watching global financial markets, and I'd like to convey some of my knowledge today to you about this topic and how I forecast these moves, including oil busts and crashes in the Canadian dollar and all sorts of other interesting trends. So here we are. I'm going to start with an introduction to Jesse Colombo. For those of you who don't know, I'm an economic analyst and researcher, and I was recognized by the London Times in 2008 for warning about the global financial crisis starting in early 2004. And in 2008, when you had the housing crisis and the financial crisis, I was 22 years old, so I was fairly young. And I got my career started basically by warning about crises. And since then, as many of you know, I've been warning about dangerous post-2009 economic bubbles that are developing all over the world, not just the United States, but in Asia and Latin America, certain sectors within the U.S. economy, Northern Europe, the whole gamut. It's just unbelievable. And I'm sure I could have countless webinars just to discuss that topic alone, and hopefully that's something that we can do in the future. And I'm also a columnist for Forbes.com, so I write many of my ideas and reports about various bubbles on Forbes.com, along with trading ideas that I have or market analyses. And many of you have seen those. Probably discuss that a little bit later on in the webinar. I'm a social media personality, quite active on Twitter, Facebook, Google+, you name it. It gets exhausting to maintain all these social networks, but I am extremely grateful for it and for all the followers and fans who have been with me for so many years and have supported me, and it's you guys that keep me going, so thank you so much. And recently, I partnered with Cyber Trading University to teach Forex and futures webinars and classes, along with other topics that we're going to develop in time. So it's definitely an open-ended type of deal where I'm not limited just to Forex and futures or trading. It could be many different topics, and I'm really excited to go ahead with those. But for today, we are going to discuss intermarket analysis. And this isn't just relevant for people who trade currencies or people who just trade futures. It's for anyone who trades or invests in the stock market or is even a concerned citizen who's concerned about what's happening in the global economy today and would like to be more informed. So I'm not gearing this presentation just for people who are Forex traders, which is a small percentage of the population, whereas many of us are concerned about what's happening around the world or just want to be more informed. So intermarket analysis is using one financial market to predict or forecast moves in other related markets. This concept was first discussed in great detail by technical analyst John Murphy back in the 1980s. He wrote 2 books on this topic called Intermarket Analysis, and you can Google that and find it on Amazon, used inexpensively, and I find it to be a tremendous resource. It's one of the first few trading or finance books that I read back when I was in high school, and I still have it on my bookshelf to this day and still refer back to it. And of course, I've taken intermarket analysis a step further and added my own unique ideas and take to it and helped to evolve it. So I'm going to discuss that today. And basically, intermarket analysis uses established relationships and correlations among currencies, commodities, bonds, equities, and other types of assets to forecast various markets. And what we do is we look for chart patterns or certain signals in one market because they oftentimes have similar implications for other correlated markets, as we'll show you in subsequent slides. So here are the most important intermarket relationships to memorize, or at least be aware of. The number one most important by far is the US dollar versus other currencies and commodities. There's an inverse relationship. And essentially, what this means is that when the US dollar, or the US dollar index, which I'll discuss, when the dollar rises, other currencies and most commodities tend to fall, and vice versa. If the US dollar falls, other currencies from the euro to the Canadian dollar, Australian dollar, rise along with commodities. That's one relationship. The next one is commodities versus bonds. It's another inverse relationship. And the reason why is because inflation is not good for people who own bonds because it erodes their interest payments. So bondholders love low inflation environments. So when you have a major bull market in commodities like we saw last decade, starting around 2002 and ending relatively recently, as they say, the commodities super cycle, it's one of my main themes that I discuss, and one of the bubbles that I've been warning about for 3 years is this commodities bubble or the commodities super cycle. And when you have a commodities bull market, bonds don't fare very well. On the other hand, when you have a commodities bust like we've been experiencing for the past 7 months or so, bonds do very well. And that's one of the main reasons why U.S. Treasury bonds and other high-quality bonds have been rallying. And this has confounded many economists because many economists were expecting that the ending of the Fed's QE and the eventual tightening of Fed monetary policy was going to hurt bonds, and yet the opposite occurs. And the missing key to that equation is the commodities bust and falling inflation expectations. And one of the main reasons why this occurred was because of the US dollar rally, which goes back to point number 1. But I'm going to show you in a visual manner and discuss this relationship a bit more in coming slides. Another relationship to be aware of is equities versus bonds. This was true more so before the QE era, quantitative easing era, 6 years ago. Since then, it's changed a bit, but in general, this is a general principle I want you to be aware of, that there's this inverse relationship between equities and bonds, and when you have a bull market in stocks and, let's say, a healthy economy, it also corresponds with bond weakness, because as bonds fall, interest rates rise. So if you have a bull market in stocks, that's typically a sign that you have a booming economy and inflation rates are ticking up, and the central bank in question is likely to raise rates soon to try to quell inflation or try to prevent the economy from overheating, and that's what causes bonds to fall and interest rates to rise. Then, once the cycle changes and there's a hard landing or there's a bear market in stocks and the economy slows or experiences a recession, bonds will rise because the Fed or other central banks will cut interest rates so that they can try to stimulate the economy, and that leads to higher bond prices. And also because you have capital flowing out of risk assets like equities, stocks, and flowing into fixed income investments like bonds. So you have this type of cycle where it's this alternation between equities and bonds back and forth. The other relationship is commodities versus commodity currencies. And commodity currencies is a term for the currencies of economies or countries that are very, very much natural resources based. So Canada is one example, Australia is another example, and so is New Zealand. Along with Norway, many other, there are many of them, including many emerging markets, are economies that are very heavily weighted toward the production and export of commodities. Let's go to the next. So when I start to do an intermarket analysis, the first place I go is to the chart of the US dollar index, and also analyzing any type of information that's relevant to the US dollar, because as we discussed, it has an inverse relationship with practically everything, these commodities, currencies. So that's the first place to look. And the US dollar index is an index, and there's also a futures contract on this index traded in the United States, where it basically averages. Think of it as, let's say, the Dow or the S&P 500, but for the US dollar. And it's a trade-weighted index where it weights the US dollar versus our most important trading partners. From Europe, the euro has a very high weighting in this index, to Canada, to Japan is another major trading partner, and the yen is factored into here. So what it does is it aggregates to come up with a number that shows the strength of the US dollar. And I find this very useful in all my analysis. And you can see what I do is I do various forms of chart analysis on the US dollar index and use that as a starting point. You can see I drew a rising uptrend line. You can see that I drew a pennant pattern, which is one of the main patterns I keep on finding over and over and over, because they're high-frequency patterns, and they tend to be accurate. And we'll discuss that in more detail in coming slides, of course. You can find the US dollar index through many data providers. One of them is barchart.com. That's what I used for this slide. Another one is finviz.com, Finviz.com. You can just Google it or go to the website, and you can go to the futures section and just click right on the dollar index. I'm watching it all the time, daily, and it's that useful. And you can see how this bull market in the US dollar starting back in July 2014, you can see how it corresponds with the commodities bust. And the commodities bust really accelerated in early July, and that's when oil basically started to break down in earnest. And you can see, as I showed here, this was basically where everything accelerated for the commodities bust. And the reason why the US dollar started to rise, and I discussed this in several of my columns, including my 9 reasons why an oil bust is ahead column that I wrote back in June 2014. And I discussed this scenario where the US dollar is likely to appreciate against other currencies. And the reason why is because you have a simultaneous monetary tightening in the US, meaning the Federal Reserve was ending QE within a few months, and then discussing the ending of ZIRP, or zero interest rate policy, meaning they're looking to be raising their interest rates after 6.5 years or so of virtually 0% interest rates, or the Fed funds rate. So that represents a monetary tightening, and that's because the Fed thinks that there's this recovery, and they now want to normalize their monetary policy. And then on the flip side, you have in Europe, the ECB, or European Central Bank, discussing, and 2 weeks ago it launched its QE program. It's a 60 billion euro per month QE program. So that weakens the euro, which then pushes up the US dollar. So you have the simultaneous tightening and loosening causes a rally in the US dollar. In addition to the loosening in Europe, you also have the same phenomenon going on in Japan with their Abenomics program, where their goal was to weaken the yen against the dollar and other trading partners, other major currencies, and also to boost and pump liquidity into their economy to try to escape this deflationary trap that they've been in for a very long time. It doesn't seem to be working. And I don't expect the European QE program to work much better either, but that's probably a topic for another webinar, I'm sure. So you can see the dollar crush commodities. And there is a causal relationship. I know correlation does not mean causation, but in this case there is a causal relationship because most commodities are priced in dollars. So this is an inverse relationship that goes back likely since 1971, basically when the US dollar became reserve currency, and then the ending of the Bretton Woods Convention, and when currencies became freely floated and trading among each other. Could have been even earlier, but as far as I know, this goes back to at least 1971. So, and as we discussed, the commodities bust or bear markets of commodities boost bonds. This is the chart of T-bonds, U.S. Treasury bonds, 30-year bonds, and commodities really started to tank starting back in July 2014, and that's where you see this real strong rally in longer-term bonds or high-quality bonds, including 30-year Treasury bonds. So this has really confused so many people, but if you're aware of this inverse relationship of commodities and bonds, then you wouldn't have been caught off guard. In addition, commodity currencies were slammed. They were hit very hard by the rise in the US dollar and also the commodities crash. This is the Canadian dollar, and you can see it really started to fall hard starting back in July. No coincidence there. And Canada is a major oil exporter. So the Canadian dollar is highly correlated with crude oil. So if you're bearish on crude oil, then you're probably also bearish in the Canadian dollar, even if you don't know about it. Or if you're not aware that you're bearish or expect bearish trends and you're bearish on crude oil, then you may want to consider a short position on the Canadian dollar in general. This is the Australian dollar, another commodity currency. And you can see around the same time started to fall very hard, and Australia is a major iron ore producer and exporter, particularly to China. And anyone who's followed me knows that I've been explaining and saying and warning that China is a bubble economy, much like Japan was back in the late 80s. And China's artificial credit-driven boom has created this demand, massive demand for iron ore to build these infrastructure projects. I mean, infrastructure projects, massive apartments, empty cities. It's just mind-boggling what is happening in China, and that very few people around the world are just aware of what is happening over there. So you have this artificial demand, boosting demand for iron ore, and it caused strength in the Australian dollar. And now iron ore prices have been weakening significantly over the past year or two, and they accelerated in the last 7 months. That combined with U.S. dollar strength was pretty much the straw that broke the camel's back for the Australian dollar. So you can see it just started falling in September. I'm going to discuss how to forecast this or how to actually trade it. So, how to apply intermarket technical analysis. The first step is you want to identify correlated leading markets, markets that tend to move ahead of other markets or lagging markets. So some of the ones that I look at as I discuss is the US dollar index and also commodities. They tend to lead the Australian, Canadian dollars. Step 2 is you want to find chart patterns or other actionable technical information in the leading market. It could be various chart or technical formations that use price. It can also be sentiment data. You can look at sentiment surveys if you're a contrarian trader, which I do consider myself to be, where you look at certain times when investors are too bullish, you may want to consider doing the opposite. When they're too bearish, you may want to consider going long. So that would all qualify as actionable information in the leading market. Step 3, you want to look for technical confirmation in the lagging market, the one that you're trying to trade. So for me, in all of my trading or all of my analysis, I place a very high emphasis on looking for confirmation. And the reason why is because in individual markets or small markets, head fake moves or fake out moves are so common, especially now in this era of algorithmic trading and high frequency trading. It's very common to have moves where the market will feign a move or it'll fake you out and pretending it'll be moving in one direction, and then you get into the trade and then it goes the opposite way. And I find that looking for this type of confirmation among different markets that are correlated, even if they're inverse, it tends to reinforce the signal. And I'll show you in a visual way that in more detail, but you want to look for confirmation. You also want to look for certain things like, let's say you're looking at a chart pattern. You want to see a solid close above or below a major threshold or support or a resistance or a trend line. So next. So here we go. Analyzing leading markets first. I'm just showing you chart-based technical analysis. We could go into such incredible detail, and it's not the scope of this webinar. Maybe in possible future webinars we can go into other methods of analyzing markets, but I gravitate toward chart analysis. First of all, I'm a visual thinker, and I'm a visual learner. So for me, when I see raw data just listed in a table format, it doesn't really come alive to me like the way a chart does. I like to be able to visualize it, and apparently other people do too, because charts do work, and I'm constantly showing market moves or various setups that do tend to work out. Not all of them do, and that's why we have our exit strategies, of course, but I find it's reliable enough for me to keep in my trading toolbox, and that's why I keep on doing it after all these years. So you can see I'm looking at the US dollar index, and how would we know that there was going to be a bull market ahead? Well, first of all, I discussed this fundamental backdrop of simultaneous tightening of US policy and loosening of Japanese policy and European policy. So that's one way to know that you would have a bullish bias on the US dollar. But for confirmation, I want to see certain technical levels broken, because it really does have a strong psychological importance for the market, because other traders are watching it, and also algorithms are programmed to enter trades or to place trades when certain key technical levels are broken. And many of those will be former highs, or it'll be, let's say, a breakout of a consolidation range. So one of them is, you could see starting in late July 2014 that the US dollar index broke above its early 2014 high, and you can see that horizontal line. So let's say if that's not enough confirmation, you want to see more confirmation, like I tend to do. It was a consolidation in early August where you see this basically for about a week and a half or 2 weeks, the US dollar index didn't really go anywhere. It just traded in a range. And those are the two parallel horizontal lines. And then you can see in mid to late August, the US dollar index broke above that. It's what's called a resistance level. And that should have been a signal that tells you that there's some strength behind this move. Because if it can break above a major, you can see, I think that's at 8150 on this index. Now it's a new high. And then oftentimes that'll trigger all sorts of buy orders and stop loss orders for people who are short. And so new highs or new lows into new territory tend to have strong technical significance. And then almost immediately, once I saw a final pullback, once I saw a pullback in October, I drew, and I did this in real time. Many of my followers on social media should remember that I've been doing this all for a while. I connect the lows of this move because that's called a rising up trend line, and it acts as a support or a type of floor. So then that basically establishes the trend, and I want to see if the market's going to move back to that support line and bounce, or if it breaks below, that's a sign that the trend has changed. And I may want to consider no longer having a bullish bias and maybe having either a neutral bias or even a short bias, assuming there's a confirmation on the downside. And you can see in mid-December, US dollar index corrected right back to that rising up trend line. I posted on Twitter and other social networks that I have that there's a good chance of a bounce occurring right over here. And if there is a bounce and the US dollar index can break above that high of early December, that was a sign of strength in the US dollar. And also it means that there's likely to be weakness in commodities or commodity currencies or other non-US currencies. Also, when I made this slide, I think it was last week or 2 weeks ago, I showed that there was a possible bull flag in the US dollar index. That ended up being a bullish signal, believe it or not, and the dollar index rallied right up to 95, and it continued to push down commodities. So you can see how it works in reality. The other leading market is commodities. In this case, I'm using a commodities index called the Dow Jones UBS Commodities Index. And just think of it like the Dow or the S&P 500, but for commodities. And it's an average of the most important commodities from oil to to corn, to wheat, to copper, including things like cocoa. But the commodities that are in the highest demand or the most highly liquid have the highest weighting in this index, and oil is one of the high. I believe it has the highest weighting in this index. And you can see over here that a technical pattern formed this past spring, spring 2014, called the bearish head and shoulders pattern. And you can see a shoulder in March. You can see a shoulder in early July and a head at the start of May. And there's a neckline, which is that horizontal line. And that's basically a support level. And when there was a final breakdown, these head and shoulders patterns are confirmed by a breakdown below a support level. So you can see in early July, that was basically the sell signal in commodities. And that's when oil really started to break down in earnest. So just remember early July 2014, because that time is going to have some significance in the next few slides. And also there was another breakdown. There was another support level breakdown. You can see that the market just treaded water from October till December, or late November until oil plunged. I believe that was when oil plunged below 70. West Texas Intermediate crude oil plunged below 70 when OPEC decided not to cut production. That really sent oil into a panic. And you can see that was a technical breakdown. There was another bearish signal for commodities. So So just keep July 2014, early July 2014 in mind for the next slide. And you can see this is the Canadian dollar. And when did it top? Oh yeah, there we go. Early July 2014. That was the top of the Canadian dollar, or at least over the past year or so. And that was when commodities broke down. And what's interesting is that the Canadian dollar itself formed its own bearish head and shoulders pattern, except that it broke down in pretty much in September. So that was 2 months after the commodities breakdown. You see that? Broke down in early July, whereas the Canadian dollar breakdown or sell signal occurred in the fall. So you were given a few months of lead time if you were interested in taking a bearish position on the Canadian dollar or other commodities currencies. Basically, commodities told you to take a bearish bias on these currencies that are highly correlated with commodities. I find that to be very interesting. And it's not just the Canadian dollar, because the same story occurred in the Australian dollar. And it formed its own bearish head and shoulders type of pattern that finally received its breakdown confirmation in early September 2014. And that was 2 months after the commodities sell signal. So 2 months is a long time. That gives you time to say, hey, you know, I may want to consider placing some short bets. Maybe I can short ETFs, or if you're a cash Forex trader with a company like FXCM or Interactive Brokers, you can short these currencies against the US dollar or against the yen, or there are many different currency pairs that you can use, many different ways of playing this. You could buy put options. There's just so many ways of playing this that it's up to you to decide the way of going about it, but in general, the signal was given. And I've been bearish on Canada and Australia's economies because they have economic bubbles, just like the U.S. had 10 years ago. It's almost like a lag, almost with a delay. And it's because ultra-low interest rates around the world, even though for countries that were hard hit like Japan, Europe, United States, our central banks reduced our interest rates to virtually nothing to try to stimulate our economies. But countries like Australia and Canada did not have the kind of busts that we had. Yet low global interest rates have carried over into those economies, and those interest rates are too low for how fast their economies were growing. So what it's done is it's led to the creation of these credit bubbles and these asset bubbles, and this is happening around the world, emerging markets, places like Singapore, Malaysia, Latin America, Nordic countries. Pretty much almost every major open economy that is not the United States, peripheral Europe, and Japan is experiencing a bubble of some sort, of varying degrees of severity, of course. And I'll discuss this in future webinars because it is really so important. I've been spending so many years to try to get this message out, and it really has distressed me so much. And so few people are seeing it. Like, they just do not understand this relationship between ultra-low interest rates and rapid credit growth, and also rapid growth in asset prices, like property prices. So that alone is a reason for me to start looking from the bearish side for currencies such as the Australian dollar, Canadian dollar. So next, I like to find confirming chart patterns, or when you look at two markets that are correlated, I like to see similar technical signals being given. So here's an example of this. This is West Texas Intermediate crude oil. This is only in the past few months. And these are two bearish pennant patterns. And I've been showing these and have been watching them before they broke down. And I noticed, I was like, when I saw in early December, I said, this looks like a bearish pennant pattern. When oil broke below 70, most people thought, this is it. This has to be the bottom. And some people even on Twitter, when I showed this pattern, some people said, "Oh, looks like Colombo's called the bottom here in commodities." They were making fun of me, trying to say that I was going to get whipsawed or something like that with this view. And I was just showing this just out of my own curiosity. He said, just watch. What if this turns into a bearish pennant pattern, which you can see this little diagram I drew, I basically marked up the charts. It looks like a small triangle. And what it is it's a consolidation pattern. And these occur very frequently. You'd be surprised. Once you train your brain to look for these patterns, you'll see them quite often. And what happens is the market, after making a big move, like what happened after the OPEC plunge, I believe is November 28th, 2014, you'll have the market or the asset in question tread water for a few days or a few weeks, and volume will recede as the market tries to catch its bearings or try to figure out the next move. And oftentimes it'll actually it'll look like a triangle. And then in the case of a bearish pennant, let's say on a downtrend like this, then if there's a breakdown where you see oil breaking below the lower bounds of that pennant, that's a sign to sell. And traders can short, and they can do quite well by shorting in this case. Or if it's a bullish pennant, it'll be an established uptrend. You'll see one of these little triangles form. And once it breaks above it, you may want to consider taking a long position. So I found these two bearish pennants, one in late November, early December, another one in late December. And then I noticed the same thing developing in the Canadian dollar at the same time. You can see how similar they look. And it's not a coincidence. And the reason why is because Canada's economy and therefore the Canadian dollar is correlated with oil because they're a major oil exporter. So for me, when I see that, I like that as a trader or as an analyst, that we're seeing similar signals. And it means it's less likely that this signal is going to turn into a head fake that's going to move against me. And sure enough, when they broke down, and when this one in December broke down, Canadian dollar broke down. It's actually dropped significantly since here. And I wrote an entire column in Forbes.com just about these two patterns. Just watch these patterns. So now I'm going to discuss the markets going forward over the next few weeks, next few months. Just a quick glance based on how I'm seeing it and how I would like to play it. Just going to discuss basically current events in the markets. So starting with the U.S. dollar index, we're still in this established uptrend, the one that started back in July. And then you can see this rising uptrend line. It's still holding. And then mid-December, you can see a steepening rising uptrend line, which means that the trend actually accelerated. And that's likely due to the ECB's QE program, and once market participants started to believe that it was going to be a reality, it helped to boost the U.S. dollar even more. And that's what really caused these commodities prices to start selling off. Right now, I've been looking for another setup or trade setup where I want to see, let's say, a consolidation pattern in the U.S. dollar index. And right now, I'm watching to see if the U.S. dollar index is going to form a bullish pennant, or one of those little triangles I showed in a few slides ago, or a flag, which has similar implications, but it would have two horizontal lines that are parallel with each other. And the resistance level is 95.50. And if the U.S. dollar index can break above that, then it means further dollar strength is likely. And that could really punish commodities. Who knows? It could send West Texas crude oil down to 40, things of that nature. So right now, it's in a holding pattern. I just want to see how it's going to resolve. If it breaks below that rising trend line that's right underneath it, then that would be a sign that the trend has changed and maybe could reverse. So for now, I'm just watching and waiting. This is the euro, And don't be surprised that it looks like a completely inverse version of the US dollar index, and the reason why is because the euro has the highest weighting in the US dollar index, so that explains why it looks like a flipped version of the US dollar index. Similar situation, you have this type of steepening downtrend line. I want to see if there's going to be a pennant or a flag pattern or a similar consolidation. And if it breaks below the recent lows, which you can see the line that I drew, that would be a sign that it's likely to continue dropping even lower. So just have to watch those levels. This is the Swiss franc. Made a massive move a few weeks ago, wiped a lot of traders out, even a few hedge funds. It's not surprising to see the Swiss franc pull back a bit. It's this type of retracement. I want to see if consolidation is forming. I don't see any obvious trade setups here. It's possible if it breaks above this diagonal downtrend line that maybe there could be a rebound back up to the recent highs, but I don't see any really strong longer-term setups. See, I'm curious if in the longer run or the intermediate term that the Swiss franc is going to strengthen a bit more, especially if the euro continues to weaken, especially once the ECB truly begins its QE program, 60 billion euro per month QE program in March. I want to see if there's going to be capital flight away from these European nations that use the euro and try to, if they try to put money into various assets in Switzerland or Swiss banks, and it causes appreciation of the Swiss franc. So if the euro continues to drop, that could be a bullish trade for the Swiss franc. This is the British pound. Also trades inversely with the US dollar index, tends to be correlated with the euro. And right now it has been forming a consolidation pattern since the start of January. Could be a flag pattern. So you see those two horizontal lines. I want to see if it's going to experience a breakout or a breakdown either way. If it breaks below that 1.5 level, which is that lower level or the support level on this futures chart I just showed, that means it's likely to continue to weaken. Of course, if it breaks back above, all bets are off, but I want to see if there's going to be a solid breakdown. That could be an opportunity to maybe start taking on some shorts. Of course, this is not investment advice, just for educational purposes. I'm not recommending you take any trades, as usual. This is the Canadian dollar. I've been showing pennant patterns and all sorts of consolidation patterns as it's continued to drop. Right now, it's a bit oversold. It could continue to drop. I wouldn't want to short just because it is so oversold right now. The time to have shorted would have been back at that pennant or that little triangle back in late December. Right now, I want to see if maybe if another consolidation pattern forms, and then if oil forms a consolidation pattern, maybe experiences a final drop to 40 a barrel, that could be an opportunity to short the Canadian dollar. But right now, I wouldn't really touch it because it is on the move, but you need to get a good trade set up so it doesn't go against you. This is the Australian dollar. Recently experienced a breakdown from a flag pattern or a similar consolidation pattern that looks a lot like the British pound. I'll show you. I'll go back to a few slides. See? So this could be the way the Australian dollar broke down could be a preview for how the British pound is going to unfold when it breaks. Just keep that in mind. Of course, it needs to have a solid breakdown, and if it reverses back, that would reverse the signal. Australian dollar could continue to weaken here, especially if the US dollar strengthens. Australia, Canada, other countries, they have bubbles. So I don't think that this is the end of the weakening of these currencies. The ideal time to have shorted would have been back about a week ago when it finally broke down. I showed that to my Twitter followers. Right now, it's a bit too late. Maybe it will form a consolidation pattern and then revisit this possible trade. But it's in a confirmed downtrend for now. This is the New Zealand dollar. This is really interesting because I had been watching this for a while. In late April 2014, I wrote a report on Forbes.com about New Zealand's economic bubble, and it led to news headlines across the country. It was on the front page newspapers, because I was warning that New Zealand has a housing bubble and a credit bubble. And it was very obvious to me, using the same techniques that I used to spot the U.S. housing bubble. And I said, wow, New Zealand's just yet another country that's inflating a bubble. And of course, many of the people there just wanted nothing to do with this idea. They didn't agree with me. But that's what happens when you warn about bubbles. I've been through this before. I'm not exactly a novice, because I did warn about the last bubble, and you see so many parallels among different bubbles. It's the same human psychology at work. So back in late April, I warned that New Zealand dollar was likely overvalued. Sure enough, this summer, it weakened significantly. Then on Twitter and Scudify and some other social networks, I showed this possible bearish triangle, because I didn't know at the time which way it would break down, but I suspected that there was going to be a breakdown, just because the prior trend leading up to this pattern was a breakdown, was a bearish trend. And then when it finally broke down, that was the signal that you may want to consider taking on a bearish bias. If you trade, maybe you want to consider shorting it. And I said that there's a chance of a measured move, which is basically a move where once there's a breakdown, there could be a move of a similar magnitude as the move that led into this pattern, which is really the move from July up until late September. So I'm still watching this to see if there's going to be a move of a similar magnitude. It could continue to weaken from here. So I want to see if there's maybe it's going to form another pennant, or maybe that could be an opportunity for traders who want to get on board with this to start shorting if it forms a consolidation. But right now it's oversold. I don't like to jump in on trends that are already established until the market or asset takes a breather. So now I want to discuss how to follow the smart money. And this plays a very strong role in intermarket analysis, or how I view the world through the eyes of a trader, or someone who's analyzing the markets. And to be a successful trader, it helps to spot and follow the smart money while doing the opposite of the dumb money. And there are many different smart money indicators, but one of my favorite and one of the most accessible is the Commodity Futures Trading Commission. That's in the U.S. That's the Commitment of Traders report, and it follows what's known as the commercial hedgers in the currency futures market. These are basically institutions or companies that deal in the trade of currencies. They're not speculators, but they're import-export companies, maybe large commercial banks. They're the ones who actually deal with the currency itself rather than speculating on the price. And they know all of the trends because they are the market. They know the market because they are the market. It's not surprising. And as I explained, they're not speculators, so they're not hedge funds who are trying to profit from moves. They use the futures market as price insurance, so that, let's say, Japanese yen strength doesn't hurt them, or doesn't hurt their profits. So you have companies all over the world who are involved in using futures to try to offset risks in currencies. So that's who I follow, and they tend to be very accurate. The dumb money, on the other hand, is I basically like to trade or do the opposite of the dumb money, and they also do the opposite of the smart money. And you can track the dumb money in this Commitment of Traders report, and that is produced by a U.S. governing body, which is the Commodities Futures Trading Commission. But it is useful. It doesn't matter where you are in the world. This data still has value. And the dumb money are typically large trend-following funds. it'll be like CTAs or various types of funds that trade investor capital, and they tend to be trend followers. That's how they trade. They follow large trends. They jump on them. They do tend to capture the meat of moves or the middle parts of market moves, but they're often wrong at major market turning points because they all tend to cluster the same way, and that's when the market turns against them. So when they're all bullish on crude oil, for example, and that's what they were back this past spring, that's oftentimes when the market will turn against them. And then if they all become bearish on crude oil all of a sudden, you may want to consider buying crude oil because the market's likely to reverse against them. I'll show you all the charts in a moment. And the reason why they tend to be wrong at these turning points is because extreme speculative positions lead to what's known as a crowded trade. And these crowded trades must eventually be unwound. So let's say if these traders are long, eventually they're going to have to sell their positions, and it's going to cause the market to reverse. And the commercial hedgers do the exact opposite of these large traders, these speculators, dumb money, all these different terms for it. So I want to show you what the smart money and the dumb money are doing right now in the euro. We're going to start there and go to the other markets, the other currencies. You can see underneath this chart are the commercial hedgers in green. And you can see every time I circle it, this is a time when the commercial hedgers take on a large number of futures contracts. They're long on the market, meaning they're expecting the market to rise, or they're worried about upside risk. And the first time this happened in the past half decade was early 2010. The commercial hedgers went very long, and the large traders went very short. And this is at a time when many market participants were worried about the rapidly unfolding PIGS crisis, or the peripheral European crisis. They were worried about a Eurozone breakup, so they wanted to be short the euro. But the commercials knew better, the smart money knew better, and they went long. And sure enough, there was a reversal. And that was because of various relief programs that the ECB launched. I believe it was the LTRO and all sorts of different programs to try to shore up confidence in the currency and in the Eurozone currency unit. So you saw this reversal in the euro, and the commercials were right on that. And the large traders acted just like they always do, which is the dumb money at these turning points. The next time this happened was in mid-2012, so summer 2012. There was another scare. I believe it was related to the possibility of Greece leaving the Eurozone. And the commercials weren't having any of it. They said, no, it's time to buy, or at least bet against the large traders. The large traders were positioning themselves on the short side. You can see they had 200,000 net short contracts. And the dumb money was wrong and the smart money was right again. And you can see recently the euro broke below an important support level, which was at 1.2 to the US dollar. And that's become a resistance level now. Now that the euro is below that level, it becomes a resistance level. And it's a key technical level, and it does represent a major technical breakdown. It's definitely not a reason for optimism. But once again, you have the commercials are going long. So you really have to question, are they going to be right again like they were the last two times? And there are different reasons why they could be right and why the dumb money or the large traders may be wrong. And we'll discuss that in a few slides. I just want to keep that in mind. Conversely, the hedgers or the smart money are shorting the US dollar index. The dollar index exploded since July, but here you have it. The commercial hedgers have one of the largest short positions, actually the largest short position they've had in the past half decade. So for me, that tells me that they expect some sort of a pullback or some sort of a reversal. and we'll discuss the implications of this, but I just want to show you how they're positioned right now in the various currencies. Hedgers are long the British pound, and you can see they've been accurate. You can see early 2010, late 2011, early 2013, called that huge move, and they're doing the same thing again. So you have the British pound trades inversely with the US dollar, and you can see the pictures starting to become very clear where they're basically betting on a reversal of the recent trends in the currency market. Australian dollar, same scenario. You can see commercial hedgers have something like 75,000 net long contracts, and every time they've experienced these peaks where they've become relatively long or bullish, you'd see the Australian dollar rebound. New Zealand dollar, interestingly, the commercial hedgers have a slight long position, but it's definitely worth noting, especially because hedgers are doing the same thing or making similar moves in other markets. So even though the short-term trend is down, it looks like commercial hedgers are getting prepared for an eventual rebound. And there are some caveats here, which I will discuss. One of them is that commercial hedgers can be early. They tend to jump into these trends early on, but we'll go into more detail. Here we go. What is the smart money telling us about the Forex or currency market? I start out saying beware that the smart money, they're oftentimes early. They're hedgers, they're not speculators, so they're not so worried about market timing because they're not trying to earn returns for their investors. They're just trying to hedge their exposure to these currencies. So the timing is not as critical to them as it is for, let's say, a hedge fund trader or a retail Forex or currency trader. But it's definitely worth noting. And there could be some sort of a reversal in the not-too-distant future just because of the way they're positioning. One of the reasons why they're positioned this way is because the commercial hedgers may suspect that the long US dollar, short everything else trade has become crowded. This has been going on for 7-8 months now. At some point, you would expect to be at least a pause or reversal, even if it's temporary. You would expect nothing moves in a straight line. So it's a very good chance that the commercial hedgers are positioning for this event. One of the reasons why they may be expecting a quantitative easing related disappointment in Europe. Maybe the QE is not as effective as the market or participants have expected, and that could lead to a bullish euro move, and that would be bearish for the dollar. And something we've seen many moves that were very similar in the yen over the past 2 years of Abenomics, where there have been so many disappointments with Abenomics, and the yen rallied. So I'm just curious if the same thing is going to be, or something similar is going to happen in Europe at some point. So just keep your eyes on that. That's one. I'm just theorizing here. I'm not predicting. I'm not saying this will happen. I'm just saying just keep that scenario in mind. Another scenario that could lead to the dollar pulling back and the euro and other currencies rising is if Janet Yellen and the Fed eventually there's a shift toward dovishness, meaning they start to worry about this oil crash and commodities crash and start to worry that the U.S. economy, or we're not going to hit the Fed's inflation expectations, and they may push off the ultimate Fed funds rate hike into the future, maybe a year, 2 years, so on and so forth. That could be bearish for the dollar and bullish for the euro, at least in the shorter run. So now I want to show you just from a charting or technical perspective what I'm watching in the longer term. Just goes back to the U.S. dollar index. It's that major It's that major asset that I keep on watching. I use it as this indicator. It's so crucial to the other markets. It's the major puzzle piece that explains what's happening in the rest of the economy or the global financial markets. And something that concerns me is that you've had a bullish breakout in the U.S. dollar index. It broke above that level at 93, and that's a level that's a key technical or psychological level that goes all the way back to mid-2003. And you can see that marked the highs in early 2004, late 2005, and now we've returned to those levels, and the dollar soared above that level. So that does have important significance, and that could indicate that this is the start of a longer-term dollar bull market, assuming this breakout holds. Of course, if it reverses and goes back below, it negates the signal. And I'm going to discuss several reasons or possible reasons why this is happening, how this could play out. Here are possible dollar bullish scenarios. One of them is that the euro continues to weaken once the ECB's QE program is officially launched in March. Another one, and it's also a related scenario, is that the European economy continues to stagnate, leading to expectations of Euro QE beyond September 2016, which is when it's slated to end right now. But let's say if the European economy does not perk up as quickly as Mario Draghi expects or other market participants expect, you could see QE beyond September 2016. And that would be bearish for the euro, and that would be bullish for the dollar. And one of the reasons why I suspect this could occur is because, well, using Japan as a model, it's got a similar situation where it's just an economy that's just so overburdened with bad debt and also has negative demographic trends, meaning the aging of the population leads to slower economic growth and a less vibrant economy. So there are a lot of parallels between Japan and Europe. And Japan has not reacted to Abenomics the way many people expected, and I don't expect it to anytime soon. And that's why one of the reasons why the yen continued to weaken is because traders and investors expect even further yen weakness because the Bank of Japan is going to have to keep on printing money to try to keep this economy afloat, and Europe will probably be the same way. Another scenario that could be bullish for the dollar is the Japanese economy keeps stagnating, leading to more Bank of Japan stimulus. I just discussed this, but that would be a dollar bullish, yen bearish scenario. There could even be a yen crash. The country is, I believe it's government debt to GDP ratio, I believe, is over 200%, whereas the U.S. is just over 100%. So one of the most highly indebted economies in the world, and I don't expect that situation to end very well at all. And that could lead to much further yen weakness in time. And that would really put pressure on the dollar to the upside. Not that the U.S. dollar is this wonderful currency or anything, but being the cleanest of the dirtiest shirts, so to speak, the U.S. dollar could benefit from that. Not that the U.S. economy would benefit, because that would have deflationary implications. It would cause commodities prices to plunge, and it would definitely create ripple effects around the world. It's definitely not a scenario that we want to experience. Another possible dollar bullish scenario, and this is one of the scarier ones, is if or when the global dollar carry trade unwinds. I'll discuss this in the next slide, but this is where the U.S. dollar soars and foreign currencies continue to sell off. So here I'm going to discuss what the U.S. dollar carry trade is in the first place. And basically, for the past 6 years of zero interest rate policy, hedge funds and institutions have borrowed very cheaply in U.S. dollars from U.S. institutions, And what they've done is they've taken this borrowed capital and they've invested it in higher yielding currencies. And they earn the interest rate differential. Some of these higher yielding currencies are everything from Australia to Canada to emerging markets. You have trillions of dollars have flowed from the U.S. and low interest rate countries into these higher interest rate countries like emerging markets. And it's, for example, you'd have an institution would buy Chilean corporate bonds because they would have a higher yield than U.S. treasuries or U.S. corporate bonds, for example. And you would have this occurring across the world. And this is going on for years. And it's created all these imbalances. And so basically what these carry traders do is, if they, let's say for the sake of an example, they borrow in U.S. dollars at 1% and they invest in a bond that yields 5%, they can pocket a 4% difference. That's called the interest rate differential. And if this money is levered, meaning they're borrowing money in excess of the capital that they put into the trade as margin, that 4% could be 20% returns or 40% returns. And this carry trade has boosted the currencies, pretty much everything but the U.S. dollar, particularly these commodity currencies. It's boosted them in emerging markets. And you've seen these massive bull markets in non-U.S. currencies for the past 12 years now. It's going back quite a while. And this U.S. dollar carry trade has created economic bubbles in the countries that benefited from the carry trade. This goes back to my theme of bubbles. And in every one of my bubble reports, I've explained the U.S. dollar carry trade, and I've showed how low interest rates in the U.S. have led to asset inflation in all these other countries, from Singapore, Latin America, Canada, Norway. I mean, you name it. It's the whole gamut. We've never seen anything like this in human history. We're definitely in unprecedented times. So you have these bubbles because emerging market bonds or Norwegian bonds have continued to rise because in the West or in at least in the U.S. and Japan, there's so much demand for higher yielding investments that they're scrambling for bonds and other higher interest rate investments, and that's pushed these assets through the roof and then led to low interest rates in those countries, and then led to housing bubbles in those countries and credit bubbles, because then people in those countries could borrow at these ultra low rates and rates that were not justified by their economic situation, meaning the rates were too low for how strong their economies were growing. So the risk with the U.S. dollar carry trade is that the eventual ending of U.S. ZIRP, or zero interest rate policy, and the rallying U.S. dollar could cause this entire carry trade of the past 6+ years to unwind, and it would create a dollar short squeeze. It would cause the U.S. dollar to soar and pummel foreign currencies and related economic bubbles. And the reason why is because basically anyone who's involved with the carry trade is short the U.S. dollar, meaning they owe U.S. dollars. They owe the banks or institutions that lent them U.S. dollars in the United States. And if the dollar is going up and the currency or the asset that they purchased was denominated in another currency, and that currency is now weakening and the U.S. dollar strengthening, that means that the amount of money that they owe or the loan that they took on is growing just because of the currency exchange rate. So the rising dollar tends to cause people to close out these trades to try to avoid further losses. And there's this risk that there's going to be a real contagion where all these emerging markets and all these other countries that have done well in a ZIRP environment, now these bubbles pop and everyone's trying to get back into the U.S. dollar, not because the dollar's great, but because they have to close their trades, and it causes the U.S. dollar to soar. So that's what I'm concerned about when you see that type of breakout in the U.S. dollar index above that 93 resistance level, which is now a support level. So keep your eyes on that scenario, because that could definitely lead to a deflationary bust. And of course, the Fed would eventually try to launch a QE4 program to try to counter U.S. dollar strength. And then that's when you get into currency wars, which is not a enviable situation either, because now you have all these central banks competitively debasing their currencies. They're all trying to print and race each other to the bottom. And at that point, you would have hard assets and currency, or you would have assets like gold would be major beneficiaries of that. But we're not at the point yet where the Fed's ready to launch a QE4. Playing devil's advocate, I'm just showing the other side of the coin. Possible dollar bearish scenarios. This could be what the commercial hedgers of smart money have in mind, even if it's in the short run. Even if the dollar bull market in the longer run is for real, that doesn't mean it can't pull back temporarily, even if it's for 6 months. So the commercial hedgers may have a longer-term dollar bullish view, but maybe they believe it's just overdone, and they want to basically see if there's going to be a reversal for a time. And here are possible reasons how that could occur. I explained the U.S. dollar index may correct back to its $93 support, even if there's a larger U.S. dollar bull market. So go back to the slide. This index is actually even higher. It hit 95. But when you have, even in bull markets, you're going to have pullbacks. Nothing moves in a straight line. So let's see. Maybe it'll pull back to 93, and it could keep rising from there. If it breaks back below 93, then I would definitely rethink this, because I would say it's a reversal. Another scenario is that U.S. economic growth continues to remain tepid or slow, and there's a disappointment, or Janet Yellen and the Fed are disappointed by the low U.S. inflation rate, especially after this oil crash, and now you have other commodities are dropping too. That could cause the U.S. Fed to push back well into the future their first rate hike, and that could cause the dollar to pull back. Another one is that there's a disappointment in the ECB's quantitative easing program. I discussed that earlier. It could cause the euro to rally and the dollar to weaken, even if temporarily. And I said this has happened several times with the yen in Japan's Abenomics program. So that's the end of the content portion of this presentation, and now I just wanted to discuss an interesting deal that we have. And basically, if you're interested in learning how to trade Forex or currencies and have me teach you, I'm going to be doing many webinars and courses that you can access over $4,000 worth of Forex courses and workshops taught by myself or other instructors who are highly skilled, and we've recorded. All you need, it just costs $40, and all you have to do is open up an FXCM trading account. That's all it is. It's not a bad deal whatsoever. I'm going to give you guys the link so you can take a look at further details. I'm putting it right here in this chat box. You can just click on it right there. And in addition to this, to $4,000 worth of Forex courses and other courses I'm going to be teaching, you get 1 full week of free access to this cyber group trading room. It's a chat room that's offered by Cyber Trading University, and I've been in there for quite some time, and I actually personally know the instructors, including Cyber Trading University's CEO, Fausto Puglisi, who trades in this room, and I personally watch them trade. One of the instructors named Rich Lepis, and I've known him for quite a while, and he's, along with Fausto, are extremely skilled traders, and I would not put my reputation on the line or harm my reputation if I didn't really believe in Rich and Fausto and this program. And I recommend you come on in and just see for yourself. There's no risk. You can see how Cyber Group works and basically what it is, and I've been in it. It's traders who are trading in the NASDAQ market all day long, and they're calling out these major market moves or moves on individual stocks. You'll have NASDAQ biotech stocks or whatever's moving a very high percentage that day. The traders in this trading room are trading it. And I've personally seen Rich and Fausto calling out these moves all day long, and I'm extremely fascinated by how they trade. And they use level 2 and they use NASDAQ total view, and which is something that I had really not spent a lot of time on in the past with my own trading, because I've tended to have a longer term view. But these fellows have actually mastered intraday trading, and just come on in. I'm in there quite often, and you can interact and you can see these traders and these instructors calling out these moves in real time. And I've been duly impressed by this, and I'm committing myself to learn. So that's one of the other things that you get with this package. But you'll be getting Forex courses and workshops taught by me. You just have to open up an FXCM trading account. And some people have been concerned about FXCM because they've been in the news lately because of the Swiss franc major rally in the Swiss franc, and many currency brokers were hit hard by it. But here are my thoughts on it. The first Forex account I opened was in 2002, and it was with FXCM. And I do believe in this company. And what happened with the Swiss franc has nothing to do with FXCM. It's not their fault per se. It was really a black swan freak type of move that occurred in this market. I'm going to explain how to avoid trading in those types of scenarios, because I really thought long and hard about it, because it's a wake-up call. But FXCM was bought out recently by Leucadia, same company that bought Jefferies about a couple years ago. So they're very well capitalized, and I personally feel comfortable with them, and I wouldn't recommend them if I was concerned. And one of the ways to avoid getting caught in those types of Forex moves is simply this. Don't trade a pegged currency. The Swiss franc was a pegged currency. It was pegged to the euro. And the idea is that the SNB, or Swiss National Bank, wanted to make sure that the Swiss franc does not strengthen too much at the time when everyone was afraid that there was going to be a Eurozone breakdown. And it was causing the Swiss franc to rally too much. It was harming Swiss exporters. And what they did was they tied it to the euro, or they pegged it. And then recently, when the SNB started to worry that the ECB was going to launch its QE program and possibly weaken the euro too much, the SNB said, okay, time to end this peg. And of course, the Swiss franc found a new level, and it rallied around 25% or so, depending on which currency it's against. And many traders got caught. Many professional traders got caught. Hedge funds got caught. And some traders within FXCM got caught, of course. But FXCM didn't hold these traders to their negative balances. Even if they lost money and maybe they owed money, FXCM forgave them, said, you don't owe us anything. So I was impressed by that. I think that was a class act move. And as a Forex trader, simple, just don't trade pegged currencies. And the only other pegged currency out there that really has real relevance is the Hong Kong dollar. And that's pretty much a moot point, because most retail traders don't even have access to the Hong Kong dollar, which is pegged to the US dollar. So if you're trading currencies like the euro, the Canadian dollar, Australian dollar, they're not pegged. So you're not going to experience a massive move like that. And in general, don't over leverage yourself. You don't want to be trading with 100 to 1 or 1 to 100 leverage. Keep it conservative, like 1 to 10, maybe even 1 to 5, and you'd be surprised what those longer trends do and how much money you can make in the longer run with less risk. So you have a better risk-adjusted return if you trade with a little bit less leverage, and you can sleep better at night. So just click on that link and take a look. Take a look at everything that's being offered, and you'll have a chance of taking even more courses with me, including premium courses and workshops, and I'm excited to recording them and putting together all sorts of interesting content for you all. So now I'm going to open up the room to questions. You can just type right into that chat box. I'll do my best to answer them. I'm sure you're going to have a lot of questions. And this is not the last webinar we're ever going to do, so don't have to all ask them at once. We can definitely save it for another day because I'm going to continue doing these webinars. So we can discuss bubbles, we can discuss trading, maybe questions about me, who I am. Some of you have been following me for years, and we've been interacting for years online, and now you have a chance to hear my voice or interact with me, and I'm excited by that. And even in the future, I'd like to have webinars maybe that don't have a specific theme, where I don't have a specific topic ahead of time, where basically it'll be an FAQ, or it'll be a Q&A, where just I'll open up the floor, you guys ask me questions, and we can discuss just like friends, just like as if we're all sitting around having a beer. And I've long wanted to have that type of personal relationship with my followers. And it's so hard through Twitter. You know, it's only 140 characters, and you have so many people asking questions, and it's like sometimes I just want to speak. And sometimes I want to rant and I want to rave, and to display emotion that you just I can't convey in text form. And throughout the years, so many people have been telling me, open up a YouTube channel, and I've been on TV a few times, but I still want to go on TV and intend to and plan to. But the thing is, I noticed that the TV presenters tend to they ask specific questions. It's not an open floor where I can just discuss in a stream of consciousness manner. And it's very quick. It's only 30 to 45 seconds. So just when I'm getting warmed up, that's when it ends or cuts to commercial. So I want to see more of these. I like to have these types of open forums. And I'll be doing more of this in the future. So, okay, someone asked that they'd like to see more webinars in the future, and they're still debating whether they want to set up a brokerage account with FXCM. Is that possible? Yes, that absolutely is possible. We're going to be offering many free Forex webinars, futures webinars, swing trading, economics. I mean, I could come up with many of these webinars, and you can keep on taking them, and it's up to you to decide later on if you say, hey, I want to start trading. And what's interesting about FXCM, and this is really how I started trading when I was in high school with FXCM, you don't have to deploy a lot of money into these trades. You can start trading with just $100. I mean, it may cost. I believe there are certain minimums which we can discuss later on to open up an FXCM account. It's not very prohibitive. They're not high as far as I know, but you can, as far as an actual trade, you don't have to bet thousands of dollars. You can just, $100 trade, and you can lever it up a little bit, just so you can be trading with real money, so you feel like you're not paper trading, so it doesn't feel fake to you. And you can actually make a small profit, and then when you get good, you scale it up. Maybe next time you trade with 1,000, and then 5,000, and then 10,000, and you can keep on scaling it up. All right, I'm going to answer other questions. A lot of questions here, but I appreciate it. All right, let me look through. Nilesh says, what is the safest currency if the US dollar breaks down? Well, Nilesh, if that were to happen, I don't see that happening in the near future just based on the trends that we just discussed. But down the road, sure, yeah, it can happen. And I'm not a fan of fiat currencies or paper currencies in the longer run. Even though the US dollar index is rising, you have to realize, what is it rising against? It's rising against other fiat currencies. So how the currencies move all depends on the rate that central banks are debasing them. So if the U.S. dollar, if and when, let's say, no longer ceases to be the reserve currency, then I would expect a hard asset that has a history as a safe haven currency to do very well, and that would most likely be gold. Next, it would be silver. Silver is my trepidation about silver is that a very high percentage of demand for silver is of an industrial nature. So it does tend to be highly correlated with the business cycle. So, and that's one of the reasons why at the worst of 2008, you had silver drop 70%. So I would buy silver. I am bullish on the longer run, but I would rather buy after, let's say, the deflationary bust is priced into silver. Gold, I really do have an affinity for gold in the longer run, but I do try to time gold because I still have this mentality of a trader, and I like to make sure that I'm timing it properly. So right now you have a U.S. dollar bull market. I'd like to wait a little longer. I want to see if gold's going to 1,200 in gold's a major support level. And I've discussed this many times. I want to see if it can break below that and continue to drop more, because I want to see, like anyone, I'm a bargain hunter. I want to see if I can buy gold at 1,000 or 800. It's a very complex topic, and I have a lot of thoughts on that. All right, and some people want to know what my Twitter account is. I'm going to give that to you right now for those who don't follow me. Okay, I'm just posting this right here. The Bubble. That's what I use for almost 4 years now, and I call it the Bubble because there's a bubble of bubbles. If you ever wanted to know why the Bubble, that's why. People call me Mr. Bubbles. I'm known for that. It's become synonymous with Jesse Colombo's Bubble or Mr. Bubbles and all these different names. Hopefully I can move beyond bubbles and be known for something else in the future. And then if you don't use Twitter, maybe use Facebook. I'm going to give you my Twitter account. I'm going to use my Facebook account. So many of these social media accounts. It's a lot of work to maintain. I'm going to have an assistant someday. That's my Facebook. All right, I'm going through the questions I'm going to ask. Grant asks me, I had a hard time getting to class. I would like to know what I need to. Oh, okay, Grant. This is actually being recorded, and it's going to be posted on YouTube, so I'll post it, and we can send it over to you. So no loss. All right, let me see. Lots of questions. Let me see. Kent asks me, what is it that moved you into trading currencies as opposed to bonds, stocks, or commodities? For me, it's not. I don't view them as mutually exclusive because I don't consider myself just a Forex trader, just a currency trader. For me, markets are markets, and they're all tradable. And I'm not limited to any one. And you can see this intellectual framework that I use, as I discussed today, is Intermarket Analysis, gives signals in many different markets. So for me, I don't have this clear delineation of, well, either you're a Forex trader or you're a futures trader or you're a stock trader. For me, I consider myself an everything trader. And that's why I like brokerage accounts that allow you to trade everything all at once and use a common margin. If you're a retail trader and you're interested in trading futures and stocks and the whole gamut, Interactive Brokers is one good option. There are many different brokers. I'm not here to discuss that, but and if you want a simple, easy way to just get started, try your hand at currencies. Look at FXCM. As I started trading actually in FXCM, believe it or not, I was a 10th grader, or I was about 15 years old. I'm 29 now, and this is in 2002. And I was my good friend and I basically took that summer of 2002. We took the summer off because we were learning trading. We had already been dabbling with stocks and done quite well for 15-year-olds, of course. And then, of course, we heard that there were all these other markets, so it was like a gateway drug, basically. And once I heard you can trade currencies, I said, wow, that's really interesting. I just came back from a trip to France, and I guess currency exchange rates were fresh in my mind, and I said, oh, that's really novel. And that's when retail Forex trading was in its infancy, and it wasn't as common as it is today. And the first account I opened was FXCM, and my friend and I traded that whole summer at nighttime, believe it or not, because this was when the U.S. dollar. This is when U.S. Treasury ended the strong dollar policy in early 2012 or summer 2012. So the U.S. dollar just started its bear market, and the euro and all these other currencies started to appreciate. And most of the moves were occurring at around 3 a.m. New York time, which is where we lived. And so we became nocturnal. We would sleep by day and stay up at night for the most exciting time of day to trade, which is around 3 a.m. I believe was when the European markets opened. And we would just basically try to bet against the dollar and go long on the euro. And it's funny how it all comes full circle. All right, let me see. Someone named ZF asks me, is this recorded? Yes, it will be recorded on YouTube, and I'm going to I'll post it on my social media. So if you're a follower who knows me from social media, I'll post it on YouTube. I'll post the YouTube link on social media so you can watch it. Or we're also going to email it out to anyone who registered for this. So we'll get it to you. Let me see. Lots of questions. Burker Yargic asks me, with the expectations of a U.S. dollar interest rate increase, what do you expect of third world currencies like Brazilian real or Turkish lira? Let me see. Well, those are two countries that I explained have bubble risk. They have bubbles. If you just look at the rate of credit growth and asset price increases, and you look at interest rates, how low they are compared to where they were in the past, that's all I need to know that there's a bubble, especially when you start to analyze further and you see what is driving the economy. So if the U.S. dollar were to continue to increase, as I showed in the longer-term chart, definitely emerging market currencies would weaken further, especially once they experience credit busts or asset busts. Let's say you have a bust in housing prices in these countries. You have credit growth then turns negative. These countries' central banks are going to cut interest rates, just like we did in the U.S. 7 years ago. So when they cut interest rates, it's going to harm their currencies. So that would further contribute to the weakening of these currencies and U.S. dollar strength. So that's why I'm concerned, is that you have so many countries are in a similar situation, and that could lead to this spike of the U.S. dollar. And the only thing would slow it down, or I don't even know if it would stop, it would be a QE4. And who knows, at some point that probably will cease to be effective too, if the Fed loses credibility. After so many QEs, market participants may say, the Fed doesn't have this situation under control, and they may panic out of all these fiat currencies. So, a lot of interesting scenarios that can play out. Let me see. Is there another webinar? Thank you, Roy. I really appreciate that. He said, this was one of the best Forex webinars I've been on. I appreciate that. And it's certainly not the last. Let me see. Let's see other interesting questions. John Bond asks me, he's one of my followers from Scutify, will I offer premium content on Scutify? Yes, I definitely intend to do that. I have so many social media accounts right now. I think it's over 12. That my attention is split so many different ways. So I try my best to, like, let's say when there's an important move in the markets that I want to try to update everyone all at once, but it's like you have 12 different social media accounts. So a lot of times I tend to go to my main account, which is my oldest account, and I have the most followers on there and most engaged followers, which is my Twitter, twitter.com/thebubblebubble. But I definitely, as I continue to build up these other social media accounts, sure, yeah, and I really do like Scutify, and I'm a believer in it, and I want to offer all these premium reports. I have a lot of big plans, so many ideas, just so little time. So I really need a team of assistants. I guess it's a good problem to have, though, right? Let's see. Nilesh asked me, any preferred emerging market currency or just investing in emerging markets makes sense, including some frontier markets? For me, because these emerging markets are so highly correlated with each other, I see a lot of these currencies, they move up and down against the US dollar at a similar rate. So at some point, sure, yeah, I would consider buying it, but I don't want to do it before the possible, or not even possible, because for me, it's written in stone that there's a coming global crisis. And when that happens, first of all, in the initial stages, I would want to be in US dollars, just in the initial deflationary phase of US dollars, US treasuries. Then in the longer run, I think even those are going to experience pain, and then that's when I want to be in primarily gold and silver, possibly oil to some extent, just as a hedge. I do like farmland in the longer run. For many reasons, as an asset, but also I believe in owning property. The global population is rising, and there's just a fixed supply of arable quality farmland. And I think in the longer run, as you have these central banks continue to debase their paper currencies, I think that can only benefit farmland over the longer run. Especially, I'm 29 years old, so I have a hopefully a relatively long life ahead of me. So I'm thinking from a longer term perspective that, let's say if I were to buy a nice farm property, that maybe when I'm 40, 45, 50, 60, down the road, it's going to carry a higher price or higher value than I paid for it. And, it's nice. You have this rising urbanization. It's nice to have a piece of natural land, and just for the peace of mind going to, let's say, tumultuous times, to know you have some farmland and that you can be at least semi-self-sufficient and you can grow your own food. Not necessarily that it's going to come down to that, but I like to cover all my bases. That's how I think. I like to hedge myself against almost every scenario that's realistic. June Show asks me, is my Forex workshop on January 27th? Yeah, I realized that I didn't update this slide. Originally, it was set for January 27th. We will be offering it in the future. I don't know the specific date yet, but I will definitely keep you posted, and certainly I'll post it on my social media. We'll be doing some email marketing when I do a full currency course. I'm definitely going to be putting that out there, and hopefully many of you guys can come join me, and we can really go into the fundamentals of Forex, and you guys will come out with a lot of knowledge that you can really start deploying in the markets, not just Forex, but stocks and bonds and commodities. And I just want to teach you what I know, and just like friends, just sit down and have a virtual beer with you guys while I teach you. I enjoy this stuff, so for me, this is my passion. Why else would a 15-year-old kid study a topic like economics aside from passion, right? Tracy Bay, as a farmer yourself, you definitely know about farmland, and I'm envious of you that you have this nice farmland with all the horses. I've heard many stories, and hopefully I can say the same of myself at some point in the future too. I mean, I really just have this newfound appreciation for rural areas and just the peace of mind of being outside of these urban and suburban areas. So consider yourself fortunate. Mark Long asks me, what is my Twitter? I input it into that chat box. I'll do it again, but if you don't see it for whatever reason, it's twitter.com/thebubblebubble, or just Google Jesse Colombo, JESSE COLOMBO, and Twitter should be number 2 or 3. You'll find it. It's not that hard. Let's see, lots of questions. This is fun. I enjoy this part of it. Oh yeah, Jenny Liao asks me, are we heading for a market crash, a big bear market in a year or two? What are the signs to identify that? Jenny, as you probably are aware, if you've been following me, and I know you have been, that I am extremely concerned about what is happening around the world. Not just in the U.S., not just in Asia. I believe you're in Singapore or Malaysia. And this is happening all around the world. And we have a major problem on our hands, and it's definitely underestimated. And what it is this economic recovery is what I call a bubble recovery. It's not a genuine recovery that's driven by organic economic trends or savings or investing money that was saved. What it's driven by is artificially low interest rates, courtesy of central banks like the Fed, Bank of England, Bank of Japan, now the ECB. It's funny money. They're printing money. You know, like, you tell me how that's going to end. How bad is it that we have had to have 6 or almost 7 years of ZIRP, zero interest rate policy, just to try to jumpstart the economy? And you can see how feeble this recovery is to begin with. And that's after spending well over $10 trillion. This is what we get. And also borrowing trillions upon trillions upon trillions of dollars at all levels, from the government to consumers, to state governments in the United States, to corporations. The whole society, the whole global economy is so saturated with debt that I don't see any other way that this can end. So now it's just a matter of when are the chickens going to come home to roost? And many people are so concerned about the timing. Is it going to happen 2 months from now, 2 years from now? For me, my answer is soon enough. If it happens within the next 5 years, that's close. For me, speaking for myself, the last decade of my life flew by like it was a year. I don't know how that happened, but it's a very odd phenomenon. I was a teenager it feels like minutes ago, and here I am almost 30. So for me to think in terms of a year, 2 years, for me that's splitting hairs. And another thing too is the precise timing of the popping of bubbles is not predictable ahead of time, meaning I can't say these bubbles are going to pop on April 17th, 2017, because it's not knowable. And the reason why is because so much of the outcome of these bubbles relies on the actions of central bankers. And even the central bankers who are going to make these moves don't even know what they're going to do 2-3 years down the road. They don't even know themselves if they're going to raise rates, or how quickly they're going to raise rates, or if that's going to cause a hard landing in the U.S. economy or the Singaporean economy, or if the Japanese economy is going to reach a breaking point with debt. So much of this is just inherently unknowable. So for me, I don't fixate on the precise timing so much. For me, my concern then moves to, okay, get prepared. You know, it could happen a month from now, but it could also happen maybe 3 years from now. And every extra 6 months, every extra year that I have is a gift, because it's a gift that gives you time to prepare and to arrange your affairs to position yourself, whether it's getting out of debt, or it's building up cash and becoming more liquid, or let's say buying gold, or getting a place in the country, buying some farmland, or if you're an active trader, looking for downside signals and starting to short. So that becomes my number one concern, whereas I think everyone's so fixated, and I can see this. So many people ask me, when's it going to happen? When it's going to happen? And when you tell them it's not knowable, they don't like that answer, because they think some economist or that economist should have every answer, or that every event in economics is predictable. And I don't believe every event in economics is predictable by any human being, whether it's the number one economist in the world. Some things are not predictable. Like, we had a stock market panic this past fall because of Ebola. You tell me, how could an economist who studies monetary trends, interest rate trends, asset price valuations, you name it, how could they predict that 2 months from now, let alone 2 years from now, that there's going to be Ebola breakout? You can't predict that. So I think the key to success in trading in economics is to know what type of information is predictable and what is not predictable. And then at least you're not setting yourself up for disappointment when you know some things are just either random, or there is no type of economic indicator that I can look at or analysis I can do to tell me that Ebola is going to break out. And there are many other things like that. You see contagions in economics occur, and we've seen this throughout human history. You can see who knew that Archduke Franz Ferdinand back in the early 1900s, who knew that he was going to be assassinated by a Serbian radical, and that was going to lead to World War I? You couldn't predict that, and yet it leads to this type of contagion scenario. So that's very key to my understanding or thinking about economics, is some things you can't predict. All right. Mark Long says, like death, sooner than we like. Yeah. Except I don't really take this morbid view of the economic crisis. Many people see me as this bearish figure, and I really do hate to come across like that. I am optimistic on the fortunes of people who prepare. And I hope to be one of those people, and it's a nonstop process. It takes time to do and time to execute a strategy to prepare yourself for a crisis. And I hope that this preparation will allow me and people who follow me and people who care to do well in the crisis. And if you're a successful trader, if you're a good trader, you can actually profit and become very wealthy as a result of predicting and successfully shorting or betting against these bubbles. So that's one of the reasons why I'm so interested in trading, is because it's such a tempting thing to do. This idea of making a fortune on an obvious crisis that can be viewed from a mile away. Okay, Robert asks me a question. Could you speak a little more to the Commitment of Traders report, where to find it, what to look for, etc.? Good question. I'm going to give you the link right now. And I would like to do a webinar. I could probably do an entire webinar just on this topic of the smart money, etc. But for now, I'm going to give you the ability to watch the Commitment of Traders report on your own. You can follow the smart money. And I just sent you guys the link. It's finviz.com, just one of the many data providers where you can find it. It's free. And I just showed you the chart of the Canadian dollar, but if you go to this link, I'm sorry, I'm going to send you this. Here's this link right now. This is an overview of all the major U.S. traded futures. And if you click on any one of those assets or futures, you can see the smart money, you can see the dumb money, you can see the small traders underneath the chart. So that's the answer to that question, Robert. Finviz.com. If you have a Bloomberg terminal, it's viewable there, many different ways. Any other questions for me? I mean, certainly not the last webinar we're going to do. So if you can think of questions from now until then, you can definitely ask them to me. And if you join the cyber group, which I'm showing here, and you have 1 week access, now I'm going to be doing daily recaps at the end of every trading session at 4 p.m. Eastern Standard Time. I do a quick market update about Forex and futures and what's happening in the overall markets, so you can come and interact with me, and many people are benefiting from this, from the cyber group chat room, including myself. I've been learning things that I never came across in my own trading. And as I explained, in that cyber group, you get to interact with another person named Rich Lepis, who I've known for a couple years, and he's another young 20-something like me, and he's a legitimately amazing trader. I mean, I am blown away by him. Come on in. You get to actually ask him questions, and I may even write an article on him soon. And he has learned this type of, he's mastered NASDAQ level 2 trading. Like he just looks at the orders, and just how I show you certain support and resistance levels that are based on charts, he can spot them just using level 2. So he's actually looking at the real orders of what smart money are doing in these smaller cap NASDAQ stocks behind the scenes, and he's definitely producing results, and you can see him, he's calling the moves ahead of time. So just come on in. It's really remarkable. And you'll see me too. Like, I'm using my own methods actually on intraday, and I'm finding these patterns, and Rich and I were working together to try to teach each other our own methods and integrate them very well. Jenny Liao asks me, do you plan to write books? Absolutely. I really want to write books, ebooks, premium content, you name it. I want to do it all, but there's only one me, and it's just my attention is so split so many different ways, and it's hard. But I actually have many plans for books that I want to write, and hopefully in the near future I'll be doing that. And I'm probably going to start with an ebook. Just need to build up the energy and motivation to sit down and put something together. I have a lot on my plate, but I do have many ideas for that, and sky's the limit. There's just no end to the amount of content that can be created, so it can be daunting too, of course. Any other last-minute questions? Got to head home. It's the weekend. Got to unwind and spend time with friends and take my mind off the markets for a bit. So that's what I call therapy. Thanks for a great presentation, says Jeffrey. Thank you. Thank you, JL Chow, one of my longtime followers. I appreciate it. Great that you guys can finally hear my voice. We'll be doing more of these, so I won't be a stranger to this format now. All right, so if you follow me on Twitter, Facebook, etc., just send me a message. Let me know how it was, and give me some feedback, because I'm still learning to improve my delivery when it comes to this type of public speaking, and hopefully I'll be a public speaking superstar in the next few months, and only goes up from here. All right, thanks, my friends. We'll be talking more. Take care.